The global banking industry is under enormous pressure. Changes in the marketplace and rapid digitalization lead us to believe that those pressures will continue to build over the next several years. McKinsey's research considered two basic scenarios. The first scenario is the consensus view, with a slow economic recovery, slight increases in interest rates, and steady digital advances.
We also considered the harsher scenario, where an economic slowdown and faster digitization raise risks to the banking industry. If slow economic growth and digitization continue to erode banks' margins, particularly in Europe and the UK, more than 25% of banks' profits could be at risk in developed markets globally. We estimate that banks' profits in Europe and the UK could fall by more than 50% by 2020. Banks in the United States are in the best position to face the headwinds. Most should remain profitable under the consensus scenario, and even if growth slows, McKinsey research predicts that profits should decline by only about 1%. Emerging markets face a different set of challenges. They are structurally more profitable, with returns on equity well above the cost of capital in most cases. For them, digital disruption is not the only threat. The credit cycle looms large. Take China, for example. If the consensus scenario plays out, we would expect roughly $50 billion in banking profits to be at risk. If their growth is slower, additional Chinese credit losses could total up to $270 billion.
Regardless of which scenario ensues and where, we expect today's stormy weather to continue for banks. We believe that in order to counter the headwinds now gathering force and to remain independent and profitable, most banks will have to make transformations beyond anything they have ever attempted. We think they will need to make dramatic progress in three areas: resilience, reorientation, and renewal. Changes this big are challenging for any organization. But we are confident that a brighter future is within the grasp of any institution that fully commits to its transformation. In anticipation of many pitfalls, we are seeing only a handful of banks in each market becoming more dynamic. As a result, they are serving customers better and meeting the needs of the communities and countries where they do business, all the while also continuing to reward their investors.
So what do we mean by resilience? We mean repositioning to compete by building a solid but flexible foundation to endure a period of diminished opportunity. Building resilience will require fundamental changes in cost structure, embracing digitization, and making radical reductions in functional costs. Many banks will mitigate some declines in interest income by repricing and changing their asset-liability mix. Some will need to restore their balance sheets to health. Many emerging market banks, for example, will shift troubled loans to new entities. And banks everywhere must set broad regulatory strategy. By reorientation, we mean pivoting in the direction of the customer in the expanding digital environment. Keep in mind that today banks are no longer just competing with each other. Customers compare and shop for banking services the same way they shop for books and clothing, digitally. To stay relevant, banks must digitize the essential customer journeys and deliver the same user experience that fintechs offer. Like their customers, bankers need to start seeing their institutions not as buildings full of paper, but instead as digital platforms that process data. In fact, we believe that the institutions that outperform in the years ahead will be those that put analytics at the center of every meaningful decision.
We understand that making changes this deep can tax the abilities of any organization. One way to raise the metabolism of a change-fatigued company is to embrace agile principles company-wide. That means giving teams more autonomy. It means cultivating vital roles such as data scientists or data translators. To pull the whole undertaking together, it also means embracing experimentation and a shared set of values, emphasizing extreme collaboration and extreme customer focus.
Strategic shifts and business transformations are traditionally driven from the top down. It is true that leaders will need to make tough choices about which initiatives to lead personally and which ones to delegate. But the complexity and scale of change required in banking demands a complementary bottom-up logic.
We believe that for a bank to outperform, the entire organization must be aligned on values that place the customer first and propelled by a clear vision of customer needs. That is the digital future. It is the direction the whole world is heading, regardless of the economic challenges or regulation. The question is not whether to change, but whether you can make fundamental changes fast enough and make them stick.